Good morning, everybody. Chris Robinson, Robinson Market with today's pre-opening grain comments. Wednesday, the third day of June. I'll be on RFD TV this afternoon at 11:45. Tune in for that for a commodity update. Kind of big news, and I put it in a letter yesterday. This is a huge technical level for D's corn. If you take the entire life of contract, low to high, we basically came right back down to the 62% retracement. That's why it's been so important here to watch these technicals. Yesterday, I sent out a letter to anybody that had the July dated 480s to 470s to roll them out to August on the break. A lot of those had gained some decent value. Why do we do that? Because if we get a recovery, we're already 4 cents off the low. I'm not calling the bottom, but those puts can lose value very, very quickly, right? So we were able to get you 30 more days by using the gain in the shorter dated option. I did not want to lift the puts. The moment you lift the puts, then, we're in a situation where you might really need them. So that was point of order right there. The big news, obviously, crude oil is back up to $97. That may, if we get back up to $100, we kind of had decoupled for a couple days where crude oil rallied and corn didn't care. I think a lot of that was 3 days of fund selling. And we lived through this before. When we had our first break after the spike in March, they sold 40,000 contracts. And then a week later, they bought them all back. So they probably just sold about 120,000 contracts. Far be it from me to say that they couldn't buy them back if they needed to. It's made it very, very difficult to kind of navigate these choppy waters. But that was the two big things I wanted to talk about. There was some news yesterday. In the in the wires, the news wires. The Secretary Vaden speak to the Wall Street Journal. He said that China has already begun placing orders for U.S. soybeans as part of their 25 million metric ton purchase commitment. He expressed confidence that China would adhere to their 3-year deal for 26, 27, 28. So, the fact that our beans are well higher than South America, basically if China does buy our beans, it's going to be a state buyer, right? It's not going to be a private buyer in China because China has not lifted its 10% duty on private buyers. So I think that the purchases, if they do come, basically they're coming from the Chinese government, not from the independent traders over there. So we're going to have to continue to watch that. Now, historically, we grew 4 billion bushels and they took a billion bushels. 25 million metric tons is basically a billion bushels. It's 925 million metric tons. So that's something that the market continues to watch. And I put this in a letter last night. New crop soybeans, it's the honey badger. It has not had a big correction. July wheat gave back half of the rally. July corn gave back over half, right? D's corn gave back, just 62%. So corn and wheat got completely hammered on the on this correction, and beans only gave back 25% of the yearly rally. So that's a gift. If you've done nothing yet, I'm not too concerned about the why. What I don't want to be is a situation where you have a chance to sell or hedge, beans well above 1150, and something happens this year and we're back down to 1050, and you're frustrated and complaining. So keep a cheap put out there, guys. That's all I can tell you. The next 6 weeks are very, very important weather-wise. Again, I put this in the letter last night too. In 2012, corn dropped from the May high to the June low over $1, about $1.25. And then on that June report, we turned around and rallied from $5.50 to over $8. So about a $2.90 rally. And the only thing that drove that was the weather market. So can we still have a rally? Yeah. It all comes down to Mother Nature. And I'm not going to sit here and promise you one way or the other. I'm not going to tell you that, oh, look out, we're going to go to 350 corn, something insane like that. I'm also not going to tell you that, don't worry, we're going to be at $8. I don't know. That's why we hedge. We try to make good cash sales. Overnight, D's corn down, up a penny and a half at 468. It found support at 64 and a quarter. November beans up 5 and a quarter cent at 11.83. It found support at 73 and a half. And July wheat Chicago Tested $6, hit 5.97. It's up 3 cents now, 2 3/4 at 6.05 3/4. So if you're an end user and you use a lot of corn and wheat, or if you are someone who sold a bunch of corn before we just broke 40 cents, now's the time to be fishing your calls on. Okay, buy the calls when nobody wants them. Moving over to the protein complex. Okay, the screwworm is now 25 miles from our border. I can't imagine it's only going to be a matter of time once that gets into our border, the insanity that the press is going to have with this story. That's why I think so many speculators have been hitting the liquidation side on their cattle. There's also this continuing concern that the American consumer is not going to continue to show up to buy beef. We've been listening to that for 2 or 3 years. So the way I look at it is this. The June fat cattle options expire on Friday. That's going to be volatile. August feeders. We have tested 345 twice now. If that fails, then that probably opens up the door to one more flush lower. Again, once that hits the news, it could get a little dicey here, especially with the algorithmic traders. And usually the algorithmic traders pound on the front months, on the nearby. And then lastly, the hogs. Have we made a bottom? No, we'll see. We've seen days like this before. We made a new low, basically almost a 6-month low in July hogs yesterday, and then had a pretty big turnaround. We went from 98.30, and we finished the day at 101.60. Now, we've seen this before. It kind of fits and starts. Hogs continue to be in a downtrend. However, we did try as best as we could to roll down our puts and put ourselves in a situation to maintain a floor, but be ready for a bounce like this. At the end of the day, if you're a producer and you've got puts, you always want to lose the value on the puts. When they gain sharply in value, you need to try to take money off the table, because when we bounce, those puts lose value very, very quickly. And then I listen to guys saying, well, I can't stand puts. I'm like, you got to manage them, guys. If you get a chance when they've doubled or tripled, you've got to manage them, because if we do turn around and rally, they lose value very, very quickly. That's why, that's the one rub against using options. However, it's a heck of a lot better to have a put on and then watch the market jump 4 cents than be short futures and be locked in down there and leave that 4 cents on the table. So that's why the put option is the best strategy, I think, for most producers, because all producers are always bet long. All right, guys, have a good rest of the day. Chris Robinson, Robinson Ag Marketing. Look for my podcast today. I'll be sending that at lunchtime. I'm a little bit behind schedule because we had a death in the family over the weekend. We're getting caught up here, though, so just bear with me. All right, guys, have a great rest of the day. This is Chris.